Fellow viewers, my name is Richard Land. I'm a Connecticut-based attorney and a member of the Danbury, Westport, and Southbury, Connecticut law firm Chipman, Mizuko, Emerson. As an attorney, I devote all my time and energy to estate planning, estate settlement, and trust administration. Here's another mistake. This mistake has to do with an inappropriate reliance on simple wills. When I'm talking about a simple will, I'm talking about a will that says, I give my estate to my spouse if my spouse survives me, or to my children in equal shares if my spouse does not survive me. If you're not married, the simple will would be more like, I give my estate to my surviving children in equal shares. That may be fine for many people, especially for a period of time, but even though it may be fine, you don't know if it's fine unless you or somebody starts asking questions. The picture on this slide is from another video I did, which is a video review of LegalZoom. That's right, I did a review of LegalZoom because I wanted to find out what is LegalZoom all about. I wanted to find out how good is it, how not good is it. I really went into it with the idea I was going to be fair, and even though maybe I might be biased against a system that purports to give you exactly what you need for $400 or so, I did make an effort to be objective about it. And one of the things I found is demonstrated in this picture. LegalZoom does not ask you questions at any level below your name, address, and names of your family members. It's as if they don't want to ask the questions that are vitally important. So this guy is wondering, why didn't they ask me all these important questions? They didn't even ask for my daughter's age. Why didn't they ask me about whether I was married for a second time? And why didn't they ask me whether my wife has a disability? All these questions need to be asked because they all relate to how your documents should be drafted. For example, your beneficiaries may have special needs related to disabilities. There are provisions that you can put in your documents that can help that person benefit from the trust, but at the same time not be disqualified from getting public assistance. You may be in a second marriage, and you want to make sure that your spouse is provided for, but you don't want any assets diverted from the children you have from your first marriage. We have to ask those questions. As the client, you need to be informed about provisions you can put in your documents to both benefit your spouse and lock in assets for distribution to the children of your first marriage. For another example, a beneficiary might have marital problems. Do you really want to give your inheritance to a child who has marital problems, thinking that what they get will just be embroiled in litigation regarding property settlement? Or a beneficiary may have creditor problems. It's the same type of thinking. Do you really want to give an inheritance to a child whose creditors will seize it? Instead, you can provide for the child and still protect it from the claims of the child's creditors. Or perhaps the client has a child who just can't hold on to a nickel. That child can't help himself. He's compelled to spend whatever he gets. You may need a trust arrangement to protect the child from himself or herself. There are different ways to handle all these things, but you don't even know to think about them unless somebody's asking you the questions that need to be asked. We've just described some pretty unhappy problems, but there are happier things to think about as well. For example, maybe your child has done very well. She's a billionaire, and whatever you can leave to her will just be an extra headache. And she might just say, Mom and Dad, just skip over me. Make sure my brothers and sisters and their children are taken care of. I'm going to be fine. So we need to go into all these questions. That's why a review is important, because these are things that are changing over a span of a lifetime. And when you did your will 15 years ago, when somebody was asking you questions about these matters, the answers would have been totally different. And now, when we ask them, the picture's changed, and the will you need is totally different. Different problems emerge, different goals emerge, and different solutions need to be considered. Here's another mistake that we mentioned before: the failure to give enough thought to who you select as your executors, trustees, and guardians. There are a lot of factors to consider. We try to list the important ones on this slide. Before I mentioned the online review that we offer, this list is taken from the online review. We want you to think about what traits or attributes you would like to see in your executor or trustee. So we have this list. We ask you, is your selection honest and fair? Will the beneficiaries perceive the selection that way? Does the selection have knowledge and experience in legal, tax, and investment matters? Is your selection for executor intelligent? Will he demand the respect of my beneficiaries? So the online review goes down the list, and depending on the answers to those questions, at the end of the interview, you'll be given a report that makes suggestions that you might want to consider. But the point is that these are questions you should ask yourself about the suitability of your executor, trustee, and guardian selections because, like I said before, you could have a very fine estate plan, the documents look great, but they're only as good as the people that you're depending on to carry out those instructions. So that's another reason to take another look at your estate plan every now and then. Let's talk about another mistake, the failure to give enough thought to cash needs. The factors that affect how much cash your estate will need when you pass away can change over time. This can be due to tax law changes as well as other things. For example, the cash requirements today, when the federal estate tax exemptions are close to $12 million, will be less than when the exemption was $1 million. The estate tax is a political football and will continue to change. Change is already baked into the cake. In 2026, the federal estate tax exemption is scheduled to decrease to $5 million. After adjustments for inflation, in 2026, you can expect an exemption of between $6 million and $6.5 million, but who really knows? The Connecticut estate tax law has changed a number of times. Last year, in 2021, the exemption was $7.1 million. In 2022, when this video is being prepared, it is $9.1 million. Not long ago, it was $2 million. We expect that when the federal exemption changes, Connecticut will respond with additional changes. Estate taxes are just part of the picture, though, and more recently, a small part of the picture except for the very wealthy. But in addition to estate taxes, there are debts, income taxes, and expenses. And often clients want to include cash bequests to beneficiaries. There can be many reasons for doing that, including bequests that are designed to create equality with other beneficiaries who have received property other than cash. When you did your planning 10 or 15 years ago, it was probably a completely different picture than it is now. Back then, what you might have had was a home and a life insurance policy, and that's it. Back then, a life insurance policy may have provided plenty of cash to pay the bills, and that might have been the end of the inquiry. But over time, things changed. Now you have a home, and you have a very large retirement account like an IRA, and you have no life insurance at all. One thing I want to emphasize when you're thinking about your estate's cash needs is that your IRA or your retirement account is a very bad choice for your executor to get cash to pay your bills after you pass away, because every time your executor takes money out of that account, there will be an income tax on the amount withdrawn. We therefore don't want you to consider the IRA a liquid asset. So part of the inquiry is how much cash will your estate need to take care of taxes, debts, expenses, and cash bequests? And where's the cash going to come from? That's part of the review process, and failing to reassess cash needs is a mistake that often occurs. I'd like to say a few more things about tax law changes. Here's a table of how the federal estate taxes have changed over the years, and you can see there's a big difference in that 9-year period. We're bumping into another period of extreme uncertainty when it comes to estate taxes. It may even include repeal. I think there's a very high likelihood that repeal will happen. And if it does happen, you've got to be watching out for what replaces it. So what will replace it? It seems to me like the most likely thing that will replace it is something close to the Canadian system. I understand that under the Canadian system, the capital gain on your assets is taxed at death. In other words, capital gains taxes must be paid shortly after you pass away. So that if you purchased XYZ stock at $10,000, we call that the cost basis in 1995, and it's worth $50,000 now in 2022 when you pass away, a tax is assessed on the difference of $40,000. The difference between $50,000, the date of death value, and $10,000, the acquisition cost, also called the cost basis, is $50,000. That's something like the Canadian system. In the not-too-distant past, there was a lot of talk about how we might end up with that type of system. If we don't end up with that type of tax at death, we might have another type of tax that's similar, a system that postpones the capital gains tax to the future when the property is actually sold. Under current 2022 rules, when you pass away, there's an adjustment to basis up to the date of death value, and your estate or your beneficiaries don't pay a capital gains tax until the property is actually sold. In our example, under current rules, if XYZ stock is sold at the time of the owner's death for its date of death value of $50,000, there would be no capital gain tax because the adjusted cost basis of $50,000, that's the date of death value, would be equal to the sale price, which we said is $50,000, so there would be no capital gain to tax. The adjustment to basis that occurs at death can eliminate a lot of gain, but another proposal that is often mentioned is the elimination of the basis adjustment at death. That is called carryover basis. In other words, the beneficiaries would receive XYZ stock with the original or carryover basis of $10,000 instead of an adjusted basis of $50,000, so that later on, when the beneficiaries sell XYZ stock for $50,000 or more, the whole gain, $40,000 or more, would be taxed. So that could be part of a replacement tax system. Also, when it comes to taxation of gift giving, there has even been talk of making gifts a taxable event where a capital gain might be taxed. So we don't know what's going to happen, but it is 100% certain that change is coming. And when it comes, we'll get something that's very confusing that will be designed to generate revenue. It will not be taxpayer friendly. So you should be keeping your eyes on that when you're thinking about reviews. Here's what the Connecticut system looks like. You can see that not too long ago, Connecticut had a $2.6 million exemption. We don't really know what the future of Connecticut has in store because it probably will depend a lot on what happens at the federal level. That's the end of part 2 of this presentation. Thank you for viewing. We hope you found this information helpful. In our next part, part 3, we will continue to discuss reasons to review your estate plan. We will discuss inappropriate reliance on old tax planning wills that inadvertently disinherit intended beneficiaries, failure to plan for possible incapacity, and failure to consider revocable living trusts. To continue, please go to part 3.